things can go on a long time that don't make sense. But they do come to an end. I mean, the internet thing. I mean, you had these companies selling for many billions of dollars that had practically no prospects of making any money. That's a bubble. But Herb Stein one time said, anything that can't go on forever will end. Now that seems pretty.
We've seen so far, the bull run of the past 10 years is, the man that we just saw is, of course, Warren Buffett, the best investor of the world has ever seen over the years, through all the market ups and downs. His company, Berkshire Hathaway, has produced a total return of over 3,600,000.0% through its regime of acquisitions and stock investments. And a big part of that success
get too upset with price fluctuations. If you're going to do dumb things because a stock goes down, you shouldn't own a stock at all.
No, I mean, what are dumb things? Selling a stock because it goes down?
Selling a stock because it goes down. I mean, if you buy your house at $20,000 and somebody comes along the next day and says, I'll pay you 15, you don't sell it because the quote's 15. You look at the house or whatever it may be. Some people are not actually emotionally or psychologically fit to own stocks, but I think more of them would be if you get educated on what you're really buying, which is part of a business. And the longer you hold stocks, the less risky they become. Whereas the longer the maturity of a bond, the more risky it becomes.
This all success is Buffett's exceptional ability to invest during market crashes. Since he took over Berkshire Hathaway in 1965, S&P 500 has seen 12 negative years. And in 10 of those 12 years, Berkshire was still able to beat the S&P. And now in 2022, which so far is another negative year, at the age of 91, the Buffett is still making big moves year to date, and S&P 500 has lost 22%. And in Q1 alone, Buffett sunk $40 billion into the market.
So make sure you take full advantage.
The biggest mistakes we've made by far are mistakes of omission and not commission. I mean, it's the things I knew enough to do, they were within my circle of competence, and I was sucking my thumb. And that is really, those are the ones that hurt. I probably cost Berkshire at least $5 billion, for example, by sucking my thumb 20 years ago or close to it when Fannie Mae was having some troubles, and we could have bought the whole company for practically nothing. And big opportunities in life have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And to do it in a small scale is just as big a mistake almost as not doing it at all. I mean, you got to grab them when they come.
So in this video, let's zoom in. 5 Warren Buffett tips you can implement to help you invest well during this market downturn. And the absolute first thing you must remember is to avoid panic selling a good business. Some people should not own stocks at all because they just get too upset with price fluctuations if you're gonna do dumb things. Because a stock goes down, you shouldn't own stock at all. What are dumb things selling a stock just goes down? Selling a stock as it goes down. I mean, if you buy your house at $20,000 and somebody comes along next day and says, I'll pay you 15, you don't sell it because the quote's 15, you look at the house, or whatever it may be. Some people are not actually emotionally or psychologically fit to own stocks, but I think more of them would be if you get educated now on what you're really buying, which is part of a business. And the longer you hold stocks, the less risky they become. Whereas the longer the maturity of a bond, the more risky it becomes. Fair enough. But if you've done the digging and you know it's a great company and it's just being sold off like with the rest of the market, it's very silly to sell. Because the price could go lower. That's Buffett's first lesson.
Buffett's suggestion.
I have an old-fashioned belief that I should expect to make money in things that I understand. And when I say understand, I don't mean understand, what the product does or anything like that. I mean understand what the economics of the business are likely to look like 10 years from now or 20 years from now. I know, in general, what the economics of, say, Wrigley chewing gum will look like 10 years from now. The internet isn't going to change the way people chew gum. It isn't going to change which gum they chew. If you own the chewing gum market in a big way, and you've got Double Mint and Spearmint and Juicy Fruit, those brands will be there 10 years from now. So I can't pinpoint exactly what the numbers are going to look like on Wrigley, but I'm not going to be way off if I try to look forward on something like that. evaluating that company is within what I call my circle of competence. I understand what they do. I understand the economics of it. I understand the competitive.
The second tip is kind of on the complete other end of the spectrum. It's to realize that actual market crashes are huge, yet infrequent opportunities. So make sure you take full advantage. The big opportunities in life. To be seized. That is a very important quote from Warren Buffett, because the thing is, when the market dives and loses 30+%, those events happen very infrequently. I mean, sure, the market drops by 10% here or there, but to get the big market drop-offs of 30%, 40%, 50%, those events really don't come around all that often. You know, our last big one was in 2008. I mean, you could argue that 2020 was a big one, but really that just made companies fairly valued. It didn't really make the vast majority of companies
I love to play around
cheap.
on the computer, and I order my books from Amazon and all kinds of things, but I don't know who's going to win. Unless I know who's going to win, I'm not interested in investing. I'll just play around on the computer. Defining your circle of competence is the most important aspect of investing. It's not how large your circle is. You don't have to be an expert on everything. But knowing where the perimeter of that circle of what you know and what you don't know is, and staying inside of it, is all important. Tom Watson Sr., who started IBM, he said, "I'm no genius, but I'm smart in spots, and I stay around those spots." That is the key. So if I understand a few things, and I stick in that arena, I'll do okay. And if I don't understand something, but I get all excited about it because my neighbors are talking about it, stocks are going up and everything, I start fooling around someplace else.
The third tip is, what do you buy? This is very important advice, because during a market crash, you're going to hear a lot of companies making the news. You know, in 2020 it was the airlines and travel. Cruise companies right now. The companies in the news are the high-flying tech companies, but you should never invest in a company regardless of how cheap it's become. If you don't understand it, you could have bought Bayer or Lehman in 2008 because it looked incredibly cheap, but that wouldn't have worked out so well for you. So avoid buying individual companies during market crashes just because they're cheap. You have to make sure that you understand them first. You know, for me, I like social media. Defining your circle of competence is the most important aspect of investing. It's not how large your circle is. You don't have to be an expert on everything, but knowing where the perimeter of that circle of what you know and what you don't know is, and staying inside of it, is all important. Tom Watson, Sr., who started IBM. He said, "I'm no genius, but I'm smart in spots and I stay around those spots." That is the key. So if I understand a few things and I stick in that arena, I'll do okay, and if I don't understand something, I get all excited about it because my neighbors are talking about stocks going up and everything. They start fooling around someplace else. Eventually, I'll get cream, and I should. Let's move on to the fourth key rule to follow during a market crash. The next tip is to
They made a big impression on me. So I went around looking for what I call used cigar butts of stocks. The cigar butt approach to buying stocks is that you walk down the street and you're looking around for cigar butts, and you find this on the street, this terrible looking, soggy, ugly looking cigar, one puff left in it. But you pick it up and you get your one puff. It's disgusting, you throw it away, but it's free. I mean, it's cheap. And then you look around for another soggy, one puff cigarette. Well, that's what I did for years. It's a mistake. It's so much easier just to buy wonderful businesses. So now I would rather buy a wonderful business at a fair price than a fair business at a wonderful price. But in those days, I was buying cheap stocks. And Berkshire was selling below its working capital per share. You got the plants for nothing. You got the machinery for nothing. You got the inventory and receivables at a discount. It was cheap. So I bought it. 20 years later, I was still running a lousy business, and that money did not compound. You really want to be in a wonderful business because the time is the friend of the wonderful business. You keep compounding, it keeps doing more business, and you keep making more money. Time is the enemy of the lousy business. I could have sold Berkshire, perhaps liquidated it, and made a quick little profit, one puff. But staying with those kind of businesses is a big mistake. So you might say I learned something out of that mistake. And what I did with Berkshire is I kept buying better businesses. I started the insurance business, See's Candy, the Buffalo, all kinds of things. I would have been way better doing that with a brand new little entity that I'd set up rather than using Berkshire as the platform. Now I've had a lot of fun out of it. I mean,
to avoid sorting your buy. Ben Graham was really the first man to write extensively about the value investing approach, but his idea was to buy a diversified group of pretty rubbish companies and cigar bots, but they were extremely cheap. So the stockholder kind of got one last path, and then you have to sell and move. Buffett changed all of that. During a market crash, you get thrown a lot of cheap businesses, but a lot of those businesses are cheaper than the rest for a reason. So don't get sucked in by how cheap they are. Focus on whether they have, ample cash, low debt, a strong competitive advantage, great return on investor capital, and great growth, and wait for those companies to be fairly priced. That leads us to the last, yet arguably the most important tip to observe during a market downturn, and that is to always stay focused on the long term. It doesn't take brains. It takes temperament. And during market crashes, for the herd, logic and reasoning really do get thrown out the window. Everybody starts panicking and it sets off a bit of a death spiral. The more people that try and get out at the same time, the faster the market drops. So you have to be that person that isn't worried about next week or next month, but knows that the money that they do put into the market is going to be there for the next 10 years. If you can really commit to that, then investing during market crashes becomes a lot easier. Just stay focused. In the long term. Hope you enjoyed the video. If you did, please leave a like and subscribe. I'd really appreciate it. Helps out the channel. But that'll do us for today. Thanks for watching. See you guys next time. Make sure you follow Dollar Talk. For more videos, stay tuned. See you in the next